Lynde Tesar. I'm a professor of economics at the University of Michigan, and I'm very pleased to play the role of moderator here for a panel on the global economy. I think, as you all are well aware, we all are well aware, we've enjoyed a long period of stable global relations, increased trade, increased financial integration. We've all written lots of papers on those topics, and things have now shifted into reverse. And so that's the topic of today's conversation is what is the world like now that we have shifted into a different gear, and what does the future hold? And this is true for trade, but beyond trade, just relations between countries more generally, and what is going to happen to the world going forward. So I'm thrilled to be here today with two people who need little introduction, Oleg Itskhoki from Harvard University and Paul Krugman from the City University of New York. And we are going to be handling, they're going to start by speaking a bit more generally about global financial markets, trade, where are we going, what's the future? And then I have a few questions I'm going to pose, and then we will open up to conversation and questions from you. So, Oleg, take it away.
Thanks so much. Pretty good turnout for the ITM. Not bad. So, you know, there is this IGM forum on Chicago website, which is kind of cool. They ask these questions to the profession, and profession gives answers. And so I thought there were two pretty good questions. Would have been nice to ask them before April. One is, if US were to go ahead with a 10% tariff across the board, do we expect that there is a chance that there is no retaliation from the rest of the world? Is there a chance that the world will just absorb those tariffs and do nothing, right? And like my response, if I were asked, would have been, well, there is no chance. There's going to be a retaliation. A 10% unilateral thing on the rest of the world is just not an equilibrium for many, many different reasons, right? And so, but now it looks fairly possible that US might get away. If US were to stop at 10% of everybody, it might well just get away with that. I still think it's less likely that it's a less than equilibrium than not, but this is kind of quite surprising. But then the second question, to which I thought I had a very kind of clear answer, is it in the interest of the US to have a 10% tariff on the rest of the world with no retaliation, right? And so the optimal tariff argument suggests that probably yes. I mean, given elasticities, probably a 10% tariff is a big financial win for the US, right? That if US can get away with it without retaliation, we should actually advise US policymakers to do that, right? So I've talked with a few of our colleagues, and actually people are skeptical. It's not so obvious if this would be the advice that this room would give to the policymakers, that US should go ahead and do that 10% tariff and just, like ensure that nobody retaliates. Is it really in the interest of the US? And the question is why, right? I mean, I don't think we think the elasticities are such that it overshoots the optimal tariff, right? But then there are these interesting things, and a lot of things we observe in the data, right? That's been happening since April 2. One thing is maybe it just breaks the structure of equilibrium that we've been in. We've been in some sort of rule-based equilibrium that and now we shift into another type of equilibrium. Who knows how it will look like? Power-based equilibrium. It's loss of allies, some type of deglobalization. So we had a pretty interesting discussion of that yesterday in the panel. The second possibility, it could be all the stuff that happens in the financial market, right? And so it triggers something. It's not just the tariff per se, but it triggers something in the financial market. US is the center of the world financial system. Dollar is the dominant currency. And so if this triggers a change in that financial equilibrium, maybe in itself, that's a big cost. And so, I'm not sure if I probably have a comparative advantage to talk about the latter than the former. Maybe my comparative advantage is to pass it to Paul right now, but I have a few remarks of what has been actually happening in the financial market. So, April 2nd announcement, stock market, at first it's not clear what's going to happen, a 10% tariff, but then it's kind of like a 50% tariff or something like that. Stock market goes into a meltdown. What's interesting, the bond market, the yields first fall for a couple of days before yields start going up, right? So yields did not start going up right away. So the bond, and it looks like it's a sell-off of both the US equities and US bonds. And so kind of like the international investors are losing faith in assets. But then there is a fairly fast mean reversion, both in, the bonds market, the yields, came down, and, the stock market, you look at your pension savings, right? And they're not doing that badly from the beginning of the year. But one market which really shifted persistently is the exchange rate, right? And so the dollar kind of depreciated by about 10, 12% against other currencies. It was at a very appreciated level before, right? And so if we took like a baseline model to think about the effect of the tariff, the baseline model will tell us like US does a tariff, and the response of a currency market to it is a dollar appreciation. Along the way, US loses some of its financial position, right? The purchasing power of US assets that are foreign when the dollar appreciates goes down. So it's a net financial transfer to the rest of the world. It's this sort of like insurance payment that, when US triggers a trade war and dollar appreciates, that's like an insurance payment to the rest of the world. And that's something we discussed yesterday in the panel as well. And that would be a normal scenario. And in fact, the previous times US announced tariffs, dollar tended to appreciate. When Trump was elected and, it increased the probability of a trade war, dollar appreciated. And previous announcement that did. But on April 2, it depreciates, and it's the one market that's a very, very persistent depreciation, right? So now the question is, dominant currencies change about once a century. And the question is, are we lucky enough as researchers to live through one of the episodes like that, right? And are we actually collecting data right now of how this shift, if it ever were to happen, right? It's actually happening now. And so we actually have some sort of micro data about financial markets where we understand what's going on, right? And so in my mind, foreign investors, given what's happening, the use of financial sanctions in the past, the trade war with friends and allies and so on, if you're a European or Japanese investor for that matter, you're a pension fund, right? Like how confident you are that the financial tool is not going to be used against you if your government is not going to go along on some dimensions. There is some probability it will happen in the future. And so you probably want to shift away from the American assets. And we kind of see some evidence in the data that there is that shift from American assets happening, but not on a large scale. It's not standards of standard deviation, multiple standard deviation events, right? These are slow moving things, and probably investors are, slowly adjusting their portfolios. They have now a target where American assets will be a lower fraction, but it's not enough to just have a desire to sell American assets. You need to have a supply of something else to buy. And there's just not that supply out there. But one market where we see a very clear shift, right, is the currency market. And so the investors who hold a big exposure to the dollar assets, whether it's T-bills or corporate bonds and so on, they clearly are starting to buy a lot more insurance. So in the past, dollar will appreciate in bad events, right? What happened in April 2, it massively depreciated. And there is a reason to believe that this is not the only depreciation that happened, as international investors will be shifting away from, US assets. There would be further steps of this depreciation potentially. And so what we see now in the data that in the futures market, there is a big demand to sell dollars forward. So all those investors that are holding dollar bonds in their portfolio, they cannot quite sell them because there is not that much to buy else, right? But what they want is the insurance. So they want to sell dollars forward. And when they sell dollar forward, that the pressure on the exchange rate. And that's what we've been very clearly observing in the financial market. In fact, tomorrow morning, I'm going to talk about this mechanism in detail, sort of how it happens in normal times. This is not a normal time, but the mechanism seems to have been the same through kind of futures and forward markets. What's sort of interesting, and it's a bit of a caveat here, but CIP premia didn't move. Exchange rate moved a lot, but covered interest rate parities didn't move. They stayed fairly stable. So it was not like a financial crisis when typically the CIP premia shoot up, right? It was really like a big shift away from thinking of dollar as a safe currency, not from treasury bills as a safe asset yet, but from dollar as a safe currency that appreciates in bad times. And people now want that insurance. And the result of that insurance is that the dollar is weaker. There are all sorts of interesting consequences of weaker dollar for the trade balance, for sort of like general rebalancing and so on. But what's interesting is it kind of the first step along the kind of ladder of losing the dominant currency status? Perhaps it is. There is a possibility to say that this is just a blimp in the data, and like a few quarters out, it would not be that important. But this shift is very interesting. So now the last thing I was going to mention is, well, there is the strength of the dollar, and is dollar the sort of that currency that appreciates in bad times? That's one question. The second question is, there really exorbitant privilege for the US borrowing, right? And so right now, when you look at the CIP data, say against Japan, the CIP itself did move, but what's remarkable is that there is a 4% annual interest rate difference between the US cost of borrowing on US debt and Japanese cost of borrowing on Japanese debt. So it's not like US has any privilege in the cost of borrowing. And indeed, you can sort of see it in sort of the fiscal capacity of the US, right? And so maybe there is not that much privilege left in that interest rate and the low cost of borrowing for the United States, right? But the question is really like this, the cost of borrowing for US combined with the strength of the dollar. Is it sort of like the first step on that path? Or this is where we're going to be right now and things will stabilize? And I think this is a huge open question for like the next year, perhaps.
Thank you. Before I pass the mic on to Paul, I already failed as moderator. I was supposed to say, as a reminder, that the NBER promotes economic research, including the economic evaluation of the effects of public policies, but we are not making policy recommendations here today.
I didn't.
You didn't. I would thank you. So it's my job also to prevent Paul from making specific policy recommendations.
I actually did read that advisor, and actually, I'm sick of making policy recommendations. Nobody ever listens anyway. So, and I'm also, by the way, I'm a little sick of big think about the future of the world economy, because I don't know what the world economy is going to look like on August 2nd. Never mind. But so I thought I would just talk about two things that I'm genuinely at least somewhat puzzled about that seem relevant here. One of them is when and why did trade agreements stop mattering? And the second is how should we be thinking about the distributional effects of tariffs? So two quite different questions. So trade agreements, I don't know what the mix of trade people versus macro people is here, but we had an international system that was very, very much based upon international trade agreements. We got to this relatively low tariff, relatively open world economy through actually 90 years of trade agreements, beginning with 1934 and the Reciprocal Trade Agreements Act. Always, negotiated agreements. For some reason, it wasn't until like this morning that I asked, why are these agreements and not treaties? And it turns out that it's more procedural than anything else. A treaty is passed by the Senate with a 2/3 vote. An agreement is passed by both houses with majorities. It's not at all clear that an agreement is any less serious than a treaty. So it's kind of it's a contract. And we built the relatively open world economy of until the other day on a system of binding international agreements where and so which were taken very seriously. I mean, a lot of people here are way too young to remember, but when NAFTA was being negotiated, the whole tariffs were already pretty low pre-NAFTA, but the idea was that by having a formal agreement, you would give certainty, permanence, and it was deeply controversial. It was an extremely hard political hold. So, okay, yesterday we began getting a bunch of trade letters posted on Truth Social. It's a different world. And by the way, be sure they're genuine. Someone did post a perfect mock-up that looked exactly like the other letters, except this one was to the herd and McDonald Islands, which are inhabited only by penguins. But anyway, but it started with South Korea and Japan. Now, the United States has a free trade agreement with Korea. And we do not have a free trade agreement with Japan, but Japan has most favored nation status, which means that U.S. tariffs on Japan are bound. We do not, according to international trade law, we do not have the right to raise tariffs on Japan above what they were set at in the last set of trade negotiations, which I guess is the Uruguay round, so it's passed. But we have, in effect, we have what we thought were binding contracts, binding legal agreements that say that we cannot just go ahead and raise tariffs. What did the letters coming from the White House say about why we are breaking these agreements? Nothing. They didn't even mention them. And as far as I can tell, most media coverage hasn't even mentioned. I mean, tons and tons of stuff about South Korea. No mention at all in anything that I've read, except in economist substacks, of course. And yet that was a big deal and a very hard set of negotiations, and it was actually hard to get it through the legislatures in both countries. Both the Koreans and our Congresses were kind of had to be had their arms twisted hard, and so all of a sudden it just doesn't matter. And I don't actually know how that happened, but it's definitely it for what it's worth. I did spend a year in government long ago, and in the Reagan administration, but subpolitical. If people get them, I was senior international economist at the council, senior domestic economist, plus Larry Summers, whatever happened to him? Anyway, but I was you would sit in, interagency meetings, and in the Reagan administration, if the guy from USTR said of some idea that was being floated, look, that would be illegal. End of story. We did not. We had made an agreement, and the United States honored its agreements. So how did that happen? How did we lose that? Why doesn't anybody? It's not just Trump. Why doesn't anybody seem to care? And by the way, this is kind of on Oleg's point. Maybe the point about a 10% across the board tariff is not to think about it in terms of what it does in terms of optimal tariff in terms of trade, but maybe what it does to the whole system, the principle that agreements are agreements, and you don't break them lightly at any rate. So, and I don't actually quite understand, but that's my first puzzle. Okay, second, distribution, which is actually a lot of people imagine that economists think that free trade is wonderful and it's great for everybody. That's not at all what textbook international trade theory says. Trade theory is full of extreme, Stolper-Samuelson is kind of where the 20th century trade theory began, and it was saying very large distributional effects, actual declines in real wages if you reduce tariffs on labor-intensive imports, so there was a period quite some time ago now when we worried a lot about the kind of general equilibrium distributional effects of globalization. Huge arguments about to what extent could rising U.S. Wage inequality be attributed to globalization. Should we be thinking about all of that stuff now? How should we be thinking about the distributional effects? And I have an answer, but I'd be curious what other people think. I think not, because there's a funny thing about all of the income distribution effects of trade literature, which is that it all depends on incomplete specialization. Protectionism can raise real wages if it leads to an expansion of labor-intensive industries. But if you're just out of those industries entirely, then it doesn't matter. Then a tariff is just a tax. It's just a direct taxation. And I think that you can argue that the way you would have analyzed the distributional effects of tariffs 25 years ago, 30 years ago, would be very different from the way you would want to analyze it now. So there was a time when you could actually talk about, the biggest of the highest tariff rates that were announced yesterday seemed to be on countries that export a lot of apparel. And we're really going sort of after Bangladesh and all of that. And that might have, I said, well, this is good for the U.S. apparel industry, except that there is no U.S. apparel industry, right? There's basically nobody. There's a few high-end items, but there's nothing. Near my office, there's a statue 3 times life size of a garment worker huddled over because it is the garment district, but there are no garment workers. And even with these tariffs, there is not going to be a U.S. apparel industry. So are we, it's not hard to see that any of the kind of labor-intensive industries that might matter for distribution are affected at the margin. What you're left with then is that we have a set of direct taxes that are, sales tax, essentially a sales tax. I was looking to see if there's anything you can make out of what gets hit. And apparel does get hit especially hard. And I thought, well, that should be regressive on top, except as far as I can tell, apparel as a share of consumer spending is surprisingly flat across the income distribution. I think it's probably, it may be that the top quintile spends less on stuff made in Bangladesh than the bottom quintile, but that's not obvious from the data. But there's a further argument and this is, and I'm probably talking too long, but let me just say people have been arguing that this is especially regressive because people at the lower end of the income distribution spend a much higher share of their income than people at the higher end. And so it's an extremely aggressive tax. And rather, although mostly you kind of know what my attitudes are here, which I guess I'm not allowed to say, this being the NBER, but but I'm actually nervous about that argument because I think Milton Friedman had a point. We know that, yes, there's a very strong correlation between income and the savings rate at a point in time. We also know that there's no trend in the savings rate over time. And the way to explain that is to say that a lot of what you see is in effect a statistical illusion. If you look at the bottom quintile of households, it's going to be a lot of people having an unusually bad year. If you look at the top quintile, it's going to be a lot of people having an unusually good year. And it's not clear that the share of spending out of permanent income, whatever your definition of that is all that strongly related to income level. So it's not clear to me that the tariffs are as regressive a tax as they might appear. And I've been trying to get some clarity on that. But of course, what we're doing is it certainly is large. It's a large direct tax, which is at best slightly regressive, and it's being used in part to pay for reductions in I think I said direct, but I meant indirect. Interpreters do, but anyway, we're basically putting on a sales tax and cutting income taxes. Income taxes are definitely progressive, so the combination is regressive. But I don't think I think there's a lot that I don't understand yet. I don't think there's any case you can make that. Well, I would say that there is no case that these tariffs are that they're progressive, because they might be if we still had the industries, if we had any chance of actually expanding the industries that are being tariffed. But I think we're not. But anyway, so those are the two questions I have. And the big thing, what the hell is happening to the world order? God knows. Maybe.
We don't have to answer that
Right.
at one go here.
Yeah.
So you touched on so many things, but let me follow up on one thing and come back to something you talked about: financial markets and the reaction. So we recently had a jobs report. Look good. The inflation numbers look good. We even had today announcements of tariffs on copper and potentially on pharmaceuticals, and the stock market kind of. And we write a lot of papers about trade policy uncertainty, that even if we don't impose the tariffs, supposedly all of this uncertainty must be very bad for investment and for the economy. And we've got this forward-looking stock market that seems to be going meh. So is it that 10% is just fine and that's where we think we're going to settle? Is it really that the gains from trade aren't so very large? So this isn't going to be all that harmful. Like, how do we make sense of this?
So I have a very quick remark on this. It might well be that what we observe in 2 quarters from now is just a blimp, right? So there is April 2025, and then there is an aftermath which lasts a couple of months. But from the perspective of financial market and even currency market, it might look just like a blimp, and we're back to business as usual with dollar in the status of a dominant currency, and so on. And so, but so far, right, it looks like we did not have a financial event in April, right? So the measures of premium didn't go up. The stock market recovered fairly fast. So it doesn't look like it's been a financial event of that sort. Mm-hmm. The one market which looks different is the US dollar market, right? But why there, we seem that to discuss that there is a massive shift in equilibrium and a type of equilibrium that we live, but why from the perspective of the financial market, it doesn't look like much. It's hard to say. I mean, you can take a perspective of sort of inelastic financial markets here. And so there is a lot of wealth in the world. The wealth was not diminished in the world economy. That wealth needs to be allocated. At first, it might have seemed like the wealth will be shifted out of equities and put into bonds. And then you take it out of, US bonds and you to put somewhere else in bonds elsewhere, but there is not that much assets. And so that wealth still needs to be allocated. And so far investors decided they're pretty happy with the portfolios that they have. And this is the reason why we didn't have a big financial episode. But I mean, this is just kind of a guess of what's going on.
Yeah.
I think that trying to infer, but basically assuming that the markets know something, is generally, I'm a big devotee of the old Paul Samuelson remark about how the stock market had predicted 9 of the last 5 recessions. And I don't think there's any reason to believe that the markets are representing some kind of sophisticated view about how all of this is going to turn out, particularly the stock market, which has a lot of retail investors who are not doing much analysis. And interest rates are up a little, and the dollar is down substantially. That's a completely unprecedented correlation for the United States. That's an emerging market sort of thing, although it's a sort of order of magnitude smaller, right? It's sort of like Brazil divided by 10 is what we're seeing in that divergence. But I don't know how much you want to read into it. And we tend, on general, we do overstate. Economists in general tend to overstate how important trade is in terms of gains from trade, all of that. Not that it's tiny, but it's one of those things where I think there are a couple of factors that lead people to overrate the importance of trade. One is that it sounds important, right? Global. Global always sounds important. It's like the international role of the dollar, the amount of obsession about it relative to what we think it actually does. And the other is that economists love to talk about trade because comparative advantage is something we understand and the barbarians don't. So, it's kind of, if you actually look at the simulations, I guess I'm looking a lot at the PIIE stuff. The losses from protectionism, they're trying to keep up with it, but they're not. We're talking 1-2% of GDP. We're not talking about massive stuff from where we are now. And I think it might be worse than that for a variety of reasons, but.
So let me turn it around then. I think from the U.S. perspective, that might be so. But of course, a big question is it might be very, very important to other countries. And so the question is how, using our policy, not policy advising, but policy analysis, what would be, how should countries respond? Should they be working collectively through the WTO? Should they be unilaterally negotiating? Should there be retaliatory tariffs? Should there be trigger strategies in their responses?
There are very different. There's a huge difference between economic superpowers and the rest. There are, roughly speaking, there are 3 within the limits of measurement comparably sized economic powers in the world, which is us, China, and the EU. The Chinese are actually, the Chinese are actually taking it arguably very tough. They're holding back rare earths and batteries. So that's actually a lot more damaging. As some might say, in terms of that kind of confrontation, it's a lot easier to offset lost export jobs with Keynesian stimulus than it is to conjure new industries into existence. And if there's a full-on conflict between the U.S. and China, the Chinese would appear to be in the stronger position. The EU is being cautious, but the EU is always cautious. And I think there's a real possibility that they may. Actually, it's kind of interesting that I think the Trump people have said there will not be a letter to the EU. It's interesting that these really quite harsh letters to Japan and South Korea, and but no letter to the EU, and where we actually know that people in the Trump administration have, they really dislike the Europe in a lot of ways. Why isn't Europe getting the same treatment right now? And part of the answer might be that the Europeans are big enough that they might be a little bit worried about what happens if the Europeans strike back. So, what I think actually, I will predict, what I think eventually happens is that we do see a lot of kind of trade arrangements made that just bypass the United States. I mean, there's already the European, certainly Canada is talking pretty openly about trying to switch to a European focus, although, geography is not on their side.
Right, right. So, as you know, we're very well integrated with other countries, both in financial markets, but trade through our fragmentation of production and production occurring all over the world. Is there a way that the world goes forward with the US outside of the trading arrangement and these global value chains persist, but Europe becomes the hub and and we're just on the outside of that relationship? Is that a world we
I
can
think
envision?
it's. It's not clear. I haven't actually tried to do the arithmetic on it, but I think if Europe and China, and Japan and then Australia can, but if Europe and China can maintain more or less amicable trading relationships, I don't really see why you can't continue to have. I don't think there's the value chains that include European and Chinese products make much of a way stop in the United States along the way. So sure, WTO -1 that kind of drops out the United States does look feasible.
So it seems in terms of fragmentation of global value chains for goods, they could be, perfectly fragmented and target different markets. But the other important area is services, right? And financial services. And where US was sort of an undisputed leader is in financial services and payment systems and so on. So I think what raises a huge question, are we going to see a world where there would be parallel payment systems, which, it's a world that we haven't lived in? Or US will still be providing the financial and payment system services to the world. And I think, Paul made the analogy with developing countries. You can make analogy with Brexit, right? So another good analogy of April 2nd is, US started looking like UK after Brexit, and it's the loss of the status of the financial center. In the case of, UK, it's perhaps for Europe. In the case for US, it's the possibility that there's just going to be parallel payment systems and US is not going to control it. And that's, when we're talking about the dominance of the dollar and the dominant status of the dollar, that is the goods market. And so, where euro was a very successful project is a lot of trade has shifted to being denominated in euros, right? Where euro has not been a very successful project is in, bringing down necessarily yields on borrowing in Europe. And this might well happen now. And the other thing is that there is no alternative payment systems. All payment systems go through dollars right now. But I think the big question going forward is it going to be the case, or are we going to see a fragmentation in the financial system?
Yeah, that's what we have no idea how, and financial types get apocalyptic about what happens if we disrupt our current financial system. But it's but they wouldn't they? That's kind of that's their thing, and how hard it would be to I don't think there clearly would be higher transactions costs if we went to a system where you were largely doing payments in euros rather than in dollars. But these are very small costs. So is that it doesn't look infeasible. People will probably be really reluctant to do it.
Right.
But
well, I think Oleg's your analogy to a ladder, and have we taken the first step on the ladder? After Bretton Woods broke down, it's not like it's a switch where you immediately flip over to a new way of doing business. We could fumble around for a while, I think.
Well, in fact, it was very interesting. The role of the dollar increased after the end of the Bretton Woods because, a lot of de facto pegs to the dollar became, the euro became de facto. But then what's amazing is the ascent of China since 2005 actually reinforced the role of the dollar. Right. And so because China was very crucial for the dollar-based financial system, right? It was using dollar to peg to, it was using dollar to save in, to denominate its trade in, right? But now we might actually see the, effects of China becoming a big player and actually wanted to create a lot of these parallel systems.
China has the problem that, we're worried about the U.S. not honoring agreements, and China certainly has a reputation as a place where, they have capital controls and has a reputation as a place where a contract is a suggestion. And that kind of inhibits the potential role for renminbi. So if something else steps in, I would think more likely the euro. But But it's really hard to move. I mean, I think maybe my favorite paper in all of economics was the old article by Charlie Kendallberger about the international role of the dollar and the international role of English as being essentially parallel. It's really, everybody speaks English because everybody speaks English, and it's really, really hard to move off that. And the dollar may be almost equally hard.
Well, I'm aware I'm in a room with many, many, many experts, and I've had the chance to ask questions that I wanted to ask, but I should open up the floor a bit if anyone would like to. Yeah, Stephen.
Microphone or just ask?
Just ask.
Just ask. So thinking about the sort of post-Bretton Woods period and the formation of the GATT. So the GATT was a sort of international rules-based system. One has Bob Steger and how that was work. You think about it as a way of escaping the Nash equilibrium and moving towards the efficiency frontier. And if you bargain according to non-discrimination or reciprocity, countries are symmetric, you get all the way to the efficiency frontier. Otherwise, you get some way towards the efficiency frontier, not necessarily all the way. But that bargain was based on a sort of set expectation throughout the world. And maybe now the world is different. The sort of China has opened up, policies changed in a different way. And so now the world economy looks different. And so maybe that initial bargain and that point that we negotiated to initially might not be the optimal point. And so one sort of way you could interpret some of the recent changes within the framework of economics would be an attempt to bargain to a different point. So to move away from a rules-based system to a more power-based bargaining system, and presumably to move to a different point towards the efficiency frontier. Because the problem that creates is it also creates a lot of uncertainty. That on the one hand, maybe you can renegotiate and move to a different point, and there could be some gain from that. But on the other hand, as Paul mentioned, you've destroyed agreements, you've created uncertainty, and that might be particularly costly in the world of sunk costs. So I wonder whether the sort of panelists had any kind of thoughts about that general challenge of, in a world of uncertainty where unexpected things happen, and you might want to renegotiate agreements, how should we think about that? We don't really have a way of thinking about it that in a lot of our kind of models of trade policy.
But does sound, sorry, I'm talking too much, but so first, I don't actually see a story I mean, the case for reciprocal trade agreements as a way of, which I do take the Steger and Blackwell, take that stuff seriously, but fundamentally, I don't believe it. I basically believe that the purpose of all of this stuff is to protect us from ourselves. That trade agreements are fundamentally a way of disciplining our own special interests, and I don't see any way in which the world has changed that invalidates that point. I mean, there's this problem of accommodating China, but the other, and then to get more flip, but I think is relevant, is if we think that there is some strategic thinking going on that is driving what's happening, who exactly do you think is doing that strategic thinking? I mean, we know who the players are in the current U.S. administration. We know how trade policy is being made. We know how the April 2nd tariffs became the quite different April 9th tariffs, which was that the Secretary of Commerce and the Secretary of the Treasury managed to get into the Oval Office and talk the president into completely changing his tariff policy while Peter Navarro was in another meeting. And if that's if that doesn't sound to me like there's some grand strategic vision under play here. So I don't think, I think we don't, we did set up, the way we set up trade policy in the United States was, it's kind of unique in the amount of executive branch discretion, which was done it wasn't stupid. It was that we have all of these restraints that come out of international agreements, but it was clear that you needed some kind of pressure release valves. So the system couldn't be too rigid. So we gave a lot of discretionary power to the executive branch to put on tariffs on various grounds, in the expectation that the president of the United States would have a bigger view, a more global view of things than the U.S. Congress would, and which worked really well for a long time, but was, now you have a situation where pretty uniquely you can have radical policy changes with no legislation and based upon, there is not a big movement behind this, where a lot of this is just trying to model the mind of one man.
I have just two quick remarks on this. So I think it's just absolutely fascinating to think about the nature of equilibrium we used to live before April 2 and the nature of the new equilibrium. We sort of all know how the Nash looks like. Nash has fairly high tariffs. That's maybe something like the world was before Great Depression, or well, around Great Depression, after Great Depression, before GATT and WTO. We don't know how after the Second World War we got to like what was there in that system, what was strategic in that system, right? And it's clear that if U.S. provided coordination, right, by punishing everybody else, but who provided, discipline for the United States, right? Was it the Cold War and the need to have alliances that provided? What was the nature of the equilibrium that was robustly played for decades until it broke? But another interesting thing, it's not just April 2nd. I think what to me quite remarkable is the way TPP died, right? And I'm in a room where people know a lot more about this than I do, but TPP died from both parties. Neither party wanted to own TPP, right? Both party candidates wanted to kill it. And TPP is if you think you're now in a new world, it's a new Cold War, and you're trying to isolate China and build alliances around China, not through WTO, but TPP was the perfect way of doing it, but neither party wanted to go ahead with that. And that was clearly another structural break in, 2016, 17 that happened, and how you make sense of that.
Over here.
If the euro is gonna start taking some of the role that the dollar has taken in the past, do you expect Europe to need to generate deficits, trade deficits, fiscal deficits, and do you see willingness in Europe to do some of that?
All right. That's a mostly false belief that the U.S. must run current account deficits to supply reserves. It's there are other kinds of capital flow. And I think Brad Setzer recently did that. And over the past 10 years, essentially none of the U.S. current account deficit has been financed by reserve acquisition. It's the U.S. current account deficit reflects a lot of private purchases of bonds, of equities, direct investment. There are just too many margins to operate on. So that the United States is not obliged to run deficits, even if the dollar retains its role. It's just not how this thing works. And if I don't think that's there are lots of things to worry about there, but I don't think that's one of them.
I think if you're a pension fund in Europe or in Japan for that matter, you really are trying to think, if you will not be holding the US treasuries now or US corporate bonds, what else can you put in your portfolio, right? And so I think it's just kind of fascinating to think that in order to actually have a safe asset, you not only need a demand of it, you need a supply of it, right? And in a situation when there is no supply of Bundesbonds or no supply of other kind of equally safe assets, they cannot rise to the level of the safe asset status, right? And so what happened in April, there is an opening for an alternative safe asset provider. Europe has a plan to have a lot of expenditure. Well, Germany does. A lot of Europe cannot do it because they're at the peak of their fiscal capacity anyways, and that's a problem. But potentially in some scenarios of the simulation that we live in, this is the opening for another safe asset provider to come in on stage. That could have happened. Looking at the data so far, we don't see that happening, but potentially, like, this is a slow adjustment, right? The investors decided they probably want to diversify away from the dollar assets. That process can take a long time, right? And, are we going to see an emergence of alternative asset classes that will take that role? I think that's a big open question.
I mean, I don't want to suggest I'm a market insider or anything, but to the extent I have had conversations with investment bankers, they're talking about this. They're
absolutely.
actively on the table.
Absolutely.
They're thinking about how to diversify their portfolios and how to manage this, because they're reading the tea leaves and thinking total dependence on the dollar could be a big mistake.
Especially if you're like European pension fund, then you don't want to be in that position.
Well, this was JP Morgan, so they're talking about it. Linda.
Yes, just to keep on this international walls of the dollar theme, and Paul, you said that people are obsessed with this relative to what it actually does, and we were just having a conversation about the safe asset side. I mean, if there were to be a substantial decline in the international roles of the dollar, where do you think the consequences, which functions of the dollar, were they to change, would have the greatest consequences? We know that the dollar is used heavily in price setting, on trade transactions, on financial transactions. it's a portfolio issue, as you were just saying, on the safe asset side and insurance. So what are the concrete changes that would be the most impactful?
Yeah, I would say financial and trade transactions, both, it's treasury bills as collateral. It's kind of, it's oversimplifying, but largely the T-bills have been the universally accepted collateral, and lots of transactions are enabled by that. If people don't trust. Now, it is true that we're talking, it's short-term U.S. assets, not 10-year bonds, but you can imagine, I mean, if you actually thought that the Stephen Miran white paper was a guide to administration thinking, which I don't, but if you did, it does talk about all kinds of sort of attempts to force foreigners not to use our stuff, and so. Now, it's not clear to me that you couldn't be using 3-month German treasury bills for a lot of this, that you couldn't be using particularly if the Europeans get anywhere closer to some kind of Euro bond, restoring the integration of their bond markets. I don't think you could do it with renminbi, because I don't think you would be sure that you would always be able to get your money out if it was actually in Chinese. And just other things. I mean, how important is it that we have a really, really easy to use form of collateral? Aren't people more creative? Look, I mean, if you may remember that there was a lot of talk that Russia was going to implode when they were shut out of the SWIFT system. And they certainly paid a price for it, but they're still in business. So I think we probably overstate how important this kind of really, that we take infinitesimal transaction costs and raise them to twice infinitesimal. How bad a thing is that?
I think, Jay, you had your hand.
I had a very quick remark. I mean, it's odd to answer to Lynde on this because she knows better than I do, perhaps. But the way I think about it, safe asset could be replaced by another safe asset, but how? And it's really like, how would the change in the payment system happen? Now, to go across currencies, you have to go through the dollar, right?
Well,
like the dollar is really, it's the interbank market, the payment system, the settlement. You have to go between any two currencies through the dollar, right? Like in my head, I'm not sure how that change will happen, but to me, that's the biggest perhaps change. Changing on an asset and like investors coordinating on some other assets seems a much more feasible thing, but how actually the payment structure and funding structure will change, to me, that's the most robust actually role of the dollar right now.
So a sudden worldwide demand for people who still know COBOL. I don't know if you know that. Yeah, anyway.
I'll go back to Paul's point that we've just completely aggregated a whole host of agreements between sovereign countries almost without comment, and add to it Mark Carney's point where he said Canada will now have to go forward, no longer assuming good actions by the United States, or no longer really counting on it. I'm curious if you think this spreads, is this really just a trade issue, or does it extend to defense procurement, AI, social media? Like, how much of the global economy starts to shift radically if we are in a world where people just no longer assume the U.S. is a trustworthy actor?
That's immense. That's it's a completely different world. I mean, probably the book that I read most recently that had the biggest impact on me was Farrell and Newman on weaponized interdependence, and they do kind of sort of say, what if people start to think that the U.S. will abuse, and that's no longer hypothetical. And yeah, I have to say that economics is in many ways the least of it.
Got a hand back there.
I think some kind of consensus has emerged that in Trade War One, under the first administration of Trump, the Americans had to eat up much of the price increases from the tariffs. I wonder what's your view on this time around, if something structural has changed, and maybe the foreign exporters will eat most of the tariff, or if we are in for a repeat where the Americans have to eat the tariff.
25% tariffs. Foreigners would have to cut their prices by 20% to offset that. How many producers out there in the world do you think have 20% margins? It just doesn't seem to me that that's just on the math. I mean, if it was 5% tariffs, maybe, but 25%?
Oh, Renee.
Hey, this is more a question for Oleg. So you talked about the payment systems having to go through the US dollar. How does the emergence of digital currencies affect that? So one of the tools certainly being used by different foreign governments, but in particular the Chinese government is digital currency. They are angling for that spot as a reserve currency. So it's not, there's sort of push and pull factors. There's the push away from the dollar from within the United States. And by the way, I understand that some policymakers actually want a depreciated dollar. And then there's also the pull from other places. So just wondering how that affects the calculus.
Right now, it's not a competitor in terms of market share yet, right? Like if we predict 5 years out, obviously any type of turbulence of the kind that we observe now increases the probability of a shift, right? But like if you just extrapolate out of today, those shares are just tiny, right? Still, and so it's still a conventional payment system that goes through the dollars. Can we be confident that that's how it's going to stay, right? The more sanctions are used, the more financial sanctions are used, the more trade policy is unpredictable, it all increases the probability of a shift, right? But if I were to evaluate the probability of that shift in the next 5 years, I would still think of it as low, but I'm a theorist, right? So I guess this is something that really much more applied empirical people should answer.
So we're living in a world now where the legitimacy of institutions is usually being challenged. And I think we all agree that US action from the Trump administration is an existential challenge to the WTO. So as a professional economist, and this is the question to both of you, would you defend the legitimacy of the WTO? And if so, on what basis as an economist?
I mean, the WTO is I think that the GATT, still makes perfect sense as a way of, most favored nation reciprocity. What's actually funny is, we need reciprocity was the line on April 2nd, but the whole system is based on reciprocity and this kind of agreement that we're all going to have minimal tariffs and made sense. And the WTO really the WTO, the ground rules are essentially the GATT. The WTO just adds mostly, I mean, other people may dispute, but I would say mainly dispute settlement mechanism. So GATT cases dragged on forever, and under the WTO, you got decisions much sooner, but at no point has the WTO itself had any real power. The WTO is always just I guess that's true of institutions in general, right? Institutions are people. And they have power to the extent that people have agreed to abide by them. And as of certainly like 2016, we had a system in which the United States and the European Union, who were the big upholders of the system, granted the WTO a lot of power, would abide by WTO decisions even if they went against them. And I don't think that's a problem with legitimacy. It's just, and maybe can we have a WTO with the United States effectively on the sidelines? It's certainly not logically impossible, but does it? I don't know. I don't see that there's a crisis of legitimacy. I think that the crisis is that one of the major players has just decided that we don't care.
I think also, Bob, your points yesterday were sort of exactly on this. We've been in a rule-based equilibrium somehow. What supported that equilibrium, I think, is a big question. And I think it was the goodwill or commitment on behalf of the big player that supported that equilibrium. There was nothing else that was supporting it. Why the calculation has changed, right? In a different simulation of the world, there could have been two big players, right? Like, 15 years ago, one could have imagined a grand bargain between US and China, that this will be the two big players that support perhaps a different rule-based system. But clearly now on an equilibrium path, we see that there is no rule-based system, and this is probably costly for everybody involved. but supporting the rule base requires a commitment on behalf of somebody, right? Yeah, I think it's super interesting. What gives that commitment power?
Well, we can have a long discussion. So 10 years ago, I thought we had a rules-based system based on dual hegemony by the United States and the EU.
Yeah.
And the EU, I think, would still be willing to do that. So it's just,
No, that's the amazing thing. So like if somebody, and I'm far from being an expert in this room, obviously, but if somebody asked me before April 2nd, what would be the scenario to respond to the US? I thought countries will take the template of WTO of response. And the EU would act together, perhaps together with the UK and maybe even with Canada, but it's clearly not what's happening, right? So EU is not leveraging their power in the system at all, right? They're not responding because you'd think that was the simplest template to say, let's do what WTO tells us to do in response to violation of the rules, but that's just not happening.
No, but this is happening, but this is happening everywhere, right? Like the cooperative institution falls apart, the legal institution doesn't hold, and then it's the unilateral bargaining sets in so that you can get your side
The
deal.
EU is large,
And this is,
right?
this is what tariff space lets you do. It
Yeah.
creates room for wink, wink, nod, nod. I'll give you a special arrangement, and then
But you don't want to act alone, right? You have the biggest bargaining power when you act collectively, and EU has this benefit of acting collectively.
But it's also true that, in some ways it's early days yet. As I'm saying, a lot of people in the markets believe, top up. Like when Trump always chickens out. A lot of people believe that all of this will just sort of go away at the end of this month. I think they're foolish, but I think the EU is kind of reluctant to get into a full-on trade war because they're hoping that. I think probably the formula. I think I'm still steering clear of policy advocacy, but I think the formula that many countries still have in mind, that the EU has in mind, is to offer some meaningless concessions that can be spun as a great victory for the current administration, and then it all goes away.
I think on that note, we will wrap this up. I want to thank both of you.
Yeah.
All of the things that they said.